Good evening, students. Welcome to this session. Have you revised the last class? Because last class was very important. Yes. Have you revised it, students? Yes or no? Good evening, Mansha. Good evening, Shankara. Good evening, Manchika. Yes. Good evening, Mofita. Yes, students. What did we discuss in the last class? Have you revised it? As I said, the last class was very imperative. So we started with 45, 1B, isn't it? Which was in regard to what? Just revise with me. Yes, students. Which was in regard to the... Okay, Virat, you have revised partly. Okay, we'll revise it together quickly. So basically, the 45, 1B was in regard to the unit linked insurance plan, isn't it? It was in regard to the unit linked insurance plan, and we said that for the unit linked insurance plan, there is exemption under section 1010D of the Income Tax Act. But if the premium exceeds the 2.5 lakh limit, then in that particular case, that will be considered as a capital asset under 214, and there will not be any exemption under 1010D. And if there is any amount received on such ULIPs where the premium is exceeding 2.5 lakh, then we will have the capital gain under 45(1)(a) in the year in which it is received. The formula is A minus B. A is the amount received minus B is the premium paid. And in case subsequently the amount is received, then C minus D. Is it clear? Then we discussed 45(2). 45(2) was what? 45(2) was in relation to the transfer of the beneficial interest in securities, meaning that the beneficial interest in securities, if it is transferred, then it will be considered as income of the beneficial owner and not that of depository. For the cost of acquisition and period of holding, you will apply the FIFO basis. Then what was 45(3), students? What was 45(3)? Yes. What was 45(3)? Yes. 45(3) which was there was for the admission of the partner. 45(3) was the admission of the partner. Yes. Good evening, Geeta. Good evening, Manikant. So 45(3) was the admission of the partner. If the partner introduces the capital asset, then as per section 45(3), we will tax that in the hands of the partner. And the fair value of consideration will be the amount recorded in the books of the firm. The amount recorded in the books of the firm will be taken as the fair full value of the consideration. Are we clear? Yes. Then 45(4). What was that? Yes. Now you are going to revise with me 45(4) one by one. What is it? 45(4). Before that, what is covered under 9B, students? Without looking at your books, just tell me. Why 45(2)(a) and 45(3) are in specific charge? Mansha, they are specific charge, though they are taxable in the year of the transfer, but for the purpose of the full value of consideration, see 45(2)(a) which is there, or 45(2) which is there, that is particularly with regard to that the income will not be of that the person who has sold it, meaning the depository. The depository is selling it on your behalf. So income will not be of depository, but of the beneficial owner. So for that purpose, it's a specific charge. As far as 45(3) is concerned, the full value of consideration may not be received. There is not actual transfer. So the partner is bringing it as a capital contribution. So there is no actual amount that he is taking out of the firm. So therefore, there is a specific charge which is created. Clear, Mansha? Yes, what is 45(4)? Yes, students, fast. 9B is the income of the firm chargeable in the hands of the firm. Yes, Vanshika. Now, what is the trigger point for 9B? What is the trigger point for 9B? Yes, students, what is the trigger point for 9B? The trigger point for 9B was where the capital asset or the money is received by the specified person from the specified entity in connection with the, yes, Mansha, correct, dissolution or reconstitution. That is the trigger. What is the outcome? Mansha, you have given me the outcome. I was asking for the trigger. The outcome will be that it will be deemed transfer in the hands of the specified entity, Mansha. It is deemed transfer not in the hands of the specified person, but the specified entity. It is 9B is the deemed transfer by the specified entity to the specified person, and therefore it will be taxable. It will be considered as income of the specified entity in the previous year in which the capital asset or stock in trade is received by the specified person. Then 9B subsection 3 gives you what will be the full value of consideration. FMV of the capital asset or the stock in trade as on the date of receipt by the specified person. Yes, Shiva, very good. It was not money, it is stock in trade. My mistake, I told money, but it's stock in trade. I corrected it. Yes, Manshika, you are right. Shankara, receipt of capital asset by the partner from the AOP, BOI or partnership firm, which is a specified entity in connection with the reconstitution or dissolution is what is covered under 9B. Yes, money is not there in Vanshika 9B. It was my mistake. It is stock in trade. Okay. So that is section 9B. Now what is 45.4? Yes, students, I'm very happy that you are able to recollect it. What is 45.4? What is the trigger in 45.4? Yes. What is the trigger in 45.4, students? What is the trigger point in 45.4? Yes. Yes, faster students. What is the trigger? Yes, Shiva, receipt of money or the capital asset in connection with what, Shiva? Yes, Shankara, receipt of money or capital asset on the reconstitution. Yes, Shankara, very good. Receipt of money or capital asset, Viraj, on reconstitution. Yes, Vanshika, the trigger is receipt of money or capital asset on the reconstitution. Yes, Geeta, correct. Reconstitution is not the trigger, but the receipt of the money or the capital asset on the reconstitution together is a trigger. Yes, Viraj, correct. Yes, Mansha, yes, very good. And what is the outcome, everyone? What is the outcome of 45.4? Yes, Viraj, yes, Manshika, yes, Geeta, correct. What is the outcome of 45.4, students? Faster. It is the Gita, not the capital gain. It is the profit arising on the receipt of the capital asset or money. Profit arising on the receipt of the capital asset or money by the specified person. Yes, Shiva, income of partner taxable in the hands of the firm. Yes, Mofita, capital gain. You should not write the word capital gain. You should write proper wording. Profit or gains on the receipt of capital asset or stock in trade shall be deemed to be the income of the specified entity. Yes, yes, Viraj. Correct. So you should write the wordings very, very correctly. the wordings under 45.4 are that the profit or gains on the, here you can write, instead of capital gains, you should write the profit or gains arising on the receipt. Sorry. Yeah. So just write over here, profit or gains arising on receipt by specified person. Okay, shall be chargeable as income of the specified entity and it will be deemed to be the income of the specified entity in the previous year in which capital asset or money is received by the specified person. Okay, now what is the formula? It is B plus C minus D. Yes, very good, Mansha. B is the money received, C is the FMV of the capital asset as on the date of the receipt, and D is the capital balance. Okay, yes, Viraj, very good. Okay, now once we have that, okay, then what is section 48.3 saying? What is section 48.3 saying? Okay, one more thing. If A is negative, it will be considered as 0. What is reconstitution? Reconstitution means what? Yes. What is the meaning of the reconstitution under section 9B? Reconstitution means what? Yes, Vanshika, B plus C minus G is correct. What is reconstitution? Yes, Shankara, correct. What is the meaning of reconstitution? Yes. Yes, what is reconstitution? Students. Yes, you're correct. So, the reconstitution, yes, Mansha, retirement, admission, change in profit sharing ratio. Yes, Mofita, yes, Geeta. Geeta and Mofita, you have not written change in profit sharing ratio. Shankara, yes, correct. Vanshika, yes, correct. So, change in the profit sharing ratio, admission, retirement, all of that is covered. Okay. So, that is the meaning of reconstitution. Now, what does 48.3 says? Yes. What is reconstitution? Okay. What is 48.3? Yes, Prerna, correct. Yes, Viraj, correct. What is 48.3 saying? What does 48.3 try to do? What kind of deduction will it give you? I want to hear from you. 48.3 is deduction from capital assets. No, Shiva. It is not deduction from capital assets. When you are in CA final, you have to use the words very correctly and precisely, Shiva. So 48.3 is deduction from the computation of capital gain. It is not deduction from capital asset. It is a deduction while computing the capital gain. Attribution of CG, Prerna. What CG? Which attribution of CG, Prerna? Mansha, yes, very good. 48.3 will give the deduction of the amount which is chargeable to tax under 45.4. Yes, very good, Mansha. So whatever amount I have charged to tax under 45.4, that will be given to me as deduction under 48.3. What is the reason of that? What was the reason? Did I tell you? If you remember the reason, you will remember it correctly in the exam. Because if you forget the reasoning, you will have to just mug up that thing. If you are with the reason, you will don't have to mug up that. What is the reason? Yes, Prerna, you are correct. Capital gain arising from 45.4. So you should not write arising from, you should write chargeable to tax under 45.4. What was the reason? Can anybody tell me what was the reason why 48.3 was coming into picture? Yes, Shiva, double taxation effect, but what kind of double tax effect was it eliminating? Mansha, double taxation, yes, I know, but what kind of double taxation? Yes, if anybody can give me the precise answer, let me see who remembers. Yes, yes, yes. Shiva, no, it's not on because of the capital gain on sale of assets. No. Yes, other students. What was it trying to relieve? So 45(4) prepones the tax liability on account of the revaluation of the asset. When the assets are revalued, no, Mansha, it is not relieving the double taxation for 9B and 45(4). What kind of double taxation 48(3) relieves is 48(3) tries to relieve the double taxation happening because on account of the revaluation, on account of the revaluation on admission or retirement of partners, the outgoing partner may be taking up the share on account of the revaluation that has happened. Right? So because of that revaluation that has happened at today's date, there is a capital gain arising in the hands of the partner, which is taxed in the hands of the firm. But when the asset will be sold at a later date, again there will be capital gain in the hands of the firm. Yes, Vanshika, you are correct. So to avoid that, double taxation at 2 point of time. It is not relieving double taxation because of 9B and 45(4). 48(3) is not relieving double taxation on account of 9B and 45(4). 48(3) is just giving you the relief for the tax liability which has been preponed under 45(4). Now, when you are selling the asset, at that time, whatever tax you have paid under 45(4), that whatever amount has been charged in the 45(4), that you will get the deduction. Are we clear? Yes, so that is the giving you the relief for the double taxation arising on, because under 45(4) there is taxation on revaluation, and under again when you sell the asset there will be again taxability on the gain arising from the sale of asset. So all of you have not given me the correct answer, meaning you have not understood at that point of time. Are we clear now? Yes. Are we clear? Now, in case there are multiple assets, how would you attribute it? How would you attribute it to the assets? The 45(4) amount, how will you attribute it? Yes. How will you attribute the amount to the assets? The amount charged under 45(4). Yes, students. Faster. How will you attribute? Which rule we have to look into? Yes, Shiva, based on the revaluation of each asset. That is rule 8AB. Rule 8AB gives you the formula as to how do you attribute the 45(4) to each of these assets. That is based on the revaluation of each asset, the increase that has happened due to the revaluation divided by the total increase that has happened because of the entire revaluation. Yes, Prerna, correct. It is based on the revaluation amount. Okay. Yes, Mufita, rule 8AB, precisely. Yes. Very good. Now, once we have that, this is for the rule 8AB. Now, what additionally rule 8AB says? Yes, Shankara, you have correctly pointed out that rule 8AB3 prohibits the attribution under 48(3) if the amount charged under 45(4) is not relating to the revaluation of capital asset. If the amount charged under 45(4) is because of the revaluation of stock in trade, right? Then in that case, the attribution will not happen. The attribution will only happen if the revaluation is due to the, if there is amount charged in the 45(4) due to the revaluation of capital asset. Also, if the capital asset itself is transferred, if there is capital asset which is itself is transferred, then there will not be any attribution on account of that capital asset. Yes, that is the rule 8AB4 that prohibits the attribution of the amount charged under 45(4) if the capital asset itself has got transferred. Because if it is transferred at this moment, there will not be any further sale in the future and there will not be any double taxation in future. Clear? What about the depreciable asset? What you will do in the case of depreciable asset? Yes, what about the depreciable asset? What will happen in the case of depreciable asset? No, Geeta, 48(3) not applied to depreciable asset. No, that's not the correct answer. We have taken the example of patents. Yes. Yes, students. What will happen to depreciable asset? All of you, are you with me? Yes. Patents example we had done. In that case, what did we do? Yes. So, in the case of depreciable asset, the circular of 2021, the CBDT circular clarifies that 48(3) and Rule 8AB will also extend to a depreciable asset. In case the sale consideration is not exceeding WDV and the block does not cease to exist, then we will reduce from the sale consideration while we are deducting from the actual cost and WDV, right? In case the sale consideration exceeds the WDV, then in that particular case, you will reduce it from the sale consideration minus WDV minus 48(3) you will apply. Yes? Yes, to provide parity, the circular extends benefit, Geeta. Yes, you are correct. Okay, so that is about the depreciable assets. Then, what about the double taxation which is happening because of 9B at 45(4)? How is that relieved? 9B and 45(4), how is that relieved? Yes. How the double taxation is relieved for 9B and 45(4)? Yes, students. Please answer. Yes. Have you revised or not? Doesn't seem that you have revised in entirety because you are not answering. This is very important, okay? If you're not able to answer, you will not be able to solve the next question that I'm going to give you. No, Geeta, in 9B period of holding on actual basis, no. That's not the way to relieve the double taxation, Geeta. Yes. So to relieve the double taxation between 9B and 45(4), CBDT circular provides that step up the capital balance while calculating 45(4), the amount D. The step up of amount D. Rule 8AA is not there to relieve double taxation, Geeta. Step up of the amount D. How did we do that? First, calculate the 9B capital gain. And what is the tax on that gain? Then calculate the post-tax book gains. Post-tax book gains. For calculating the book gains, we may not take up the indexed cost of acquisition, right? So calculate the post-tax book gains, and whatever post-tax book gains come, allocate it between the partners of the firm or the members of the AOP or BOI, and that amount you need to add to the capital balance, which is the amount D while calculating 45(4). In this way, you will relieve the double taxation under 9B and 45(4). That is coming through the CBDT circular. Are we clear? Last one point. How will you calculate the period of holding for 45(4)? For 9B, it is on actual basis. But what is the period of holding of capital asset? How will you determine short term or long term under 45(4)? Yes. How will we determine the capital gain, whether it is long term or short term under 45(4)? Yes, students. Yes. Yes, Geeta. Prerna, yes. Rule 8AA applies. What does 8AA says? Yes. What does 8AA provide? Yes. Yes, students, faster. Geeta, but determination of period of holding, how? What does 8 Rule 8AA says? How do you determine the period of holding? Yes. How do we determine the period of holding, students? Haven't you revised? Yes. Okay. So it says that the period of holding will be attributed, yes, Mufita, correct, on basis of the capital asset to which amount taxed under 45(4) relates. So if it is short-term capital asset, then short-term. If it is long-term, then long-term. And depreciable asset and goodwill will always be short-term. So that's what section 45 period of holding says. Okay. Yes. So let's move further and I'll give you the question. Is it clear first of all? Yes. Okay, let's solve a question. So let's say there is balance sheet. There is balance sheet of a firm. Okay. Now in this particular case, let's say there are three partners. Again, A, B, and C. So just write down. I will have three partners over here, which is having 10 lakh share. Fine. They are having the 10 lakh shares which are there. Okay. Now, let's say there are three lands again here. P, Q, R. Okay. Three pieces of land. Now, again, the book value of these land is 10 lakh, 10 lakh, 10 lakh. Okay. Now, these were acquired more than 24 months ago. So, all of these are long-term capital asset. Okay. Now, partner A wishes to exit. So, the firm sells land U to the partner A. So, basically, you can write partner A retires and land P, which is there, is sold to the partner. It's transferred. Let's assume the fair market value of this is 50 lakh. Let's assume the fair market value is 50 lakh and the indexed cost of acquisition is 15 lakh. Okay, the index cost of acquisition is 15 lakh. Clear? And the rest of the lands which are there, again, for that the valuation is, let's say, 70 lakh. Okay, 70 lakh is there. And let's say, for example, on the exit of the partner, let's say 61 lakh rupees are given as money to settle his capital balance. So let's say rupees 61 lakh is given to the partner. Okay. Or let's say 11 lakh rupees, not 61 lakh rupees, 11 lakh. Of 11 lakh. Okay. Yes. So what will be the tax implication? Yes, calculate. Tell me the 9B and 45.4 and 48.3. All of these. Yes, 9B is coming to what? 9B is 35 lakh. Yes, correct. Mufita. Yes, Geeta. 9B 35 lakh and 7 lakh is the tax. You are correct. So first we write about 9B. So 9B is coming to my full value of consideration is 50 lakh minus indexed cost is 15 lakh. So this will give me 35 lakh. Tax, assuming at the rate of 20%, is going to be, since it's long-term capital gain, it's 7 lakh. Yes. Then what is the next step? What is 45.4? Trademark tax is 20%, long-term capital gain. No, Shiva, 45.4 is not correct. Yes. What will be my 45.4? Yes, Mufita, tax is 7 lakh, you're correct. So see, student, this is such a complex topic. And if you go and read it just like that, you would never understand this. That is why you need to revise this again once today very properly so that you are very, very, very thorough with it. See, once you've understood the logic of that, now, like you don't need to remember this particular provision. Otherwise, if you fail to understand logic, you will have to mug up every time. And there is no point absolutely mugging up because this is a very, very logical provision. Okay? Yes, Mufita, very good. 45.4 is 40 lakhs. Very good. Yes. Others, have you got the answer? Let's do it together. So first we'll calculate the post-tax book gains, which is 50 lakh minus 10 lakh minus 7 lakh. This will be equal to what? 33 lakh. This will be divided into A, B, C, which is 11 lakh each. Right? Now my 45.4 is going to be A is equal to value of money received 11 lakh, value of land which is there. What is the fair market value? 50 lakh minus D. My D is going to be 10 lakh plus 11 lakh. Right? So what is going to be my 45.4? What is going to be my 45.4? 40 lakhs. Are all of you getting this particular point? No, Vanshika, how did you get 51 lakh? Geeta, yes, 40 lakhs, good. Yes. Vanshika, did you understand how 40 lakhs? So, Vanshika, you have not stepped up the capital balance, I assume, which is in line with the CBDT circular. You need to step up the capital balance in order to relieve the double taxation which is happening under 9B and 45.4. Yes, Vanshika, is it clear? All of you, this much clear? What will be the nature of the capital gains? Short term or long term? Yes. Yes, Prerna, correct. Allocate 40 lakhs between Q and R. It's LTCG therefore, Prerna, because both are long-term capital assets. Yes. Yes, Geeta, correct. It's long-term capital gain. Yes, Vanshika, we added 11 lakhs and 10 lakh because what does the CBDT circular says? It says that you need to step up the post-tax capital gain which is allocable to a partner in order to relieve the double taxation under 9B and 45(4). Clear, Vanshika? Yes, Mofita, it's long-term. So, okay, so period of holding is going to be based on Q and R. So 20 lakh is of Q and 20 lakh is relating to the R. Not 20 lakh, sorry. This is in relation to the two assets, which is 60 lakhs, according to the revaluation only. So this is pertaining to Q and R. So long-term capital asset. Therefore, long-term capital. This is rule 8AA, and this is our CBDT circular number 14 of 21. Okay. Sorry, students, there was some technical glitch at my end. Okay, let's continue. No problem, Mansha, but please revise it. It's for your benefit because otherwise you would not be able to recollect it at later point of time. Okay. So then now what about section 48.3, the last point? How will you apportion between 48.3? Yes. What will happen in the case of 48.3? Yes, students. How we are going to apportion between 48.3? Yes, students. Yes, Prerna, but what will be the answer? It will be with in accordance with the rule 8AB, but what will be the answer? Yes, Geeta. So what we will do is we will calculate what is the total revaluation. This is 60. This is 60 lakh. This is revaluation. Total is 120 lakh. So in the ratio of 1:1, we will allocate it. So Q and R, which is will be 20 lakh, 20 lakh, 1:1. Okay? Yes. So this is as per rule 8AB. No attribution to P as P is transferred. This is rule 8AB 4. Okay? Yes, students, is it clear? Hope you have understood and you would be able to solve this question in the examination if it comes up. Shall we proceed further? I need yes from all of you. Are you clear? And will you please revise this once again? Yes. Shall we proceed further? Are we clear up till now? Because this is a very, very, very important concept. Yes, Viraj. Okay. Yes, Mufita. Good. Okay. So let's proceed further. Let's start with section 45.5. Okay, Shiva. So now all of you with me, rest of the provisions, we are still under the basic charge. We have not moved ahead. We are still under the basic charge. The charging section, which is 45. We have not even moved to the other sections at the moment. So today we are going to finish off the charging section and then move further. Next is section 45.5. So section 45.5. Compulsory acquisition of capital assets. Now, if you remember the definition of transfer under section 247 included the compulsory acquisition of the capital asset, right? So, this is transfer under section 247, isn't it? So, compulsory acquisition of capital asset is a transfer under section 247. So if it is a transfer, the capital gain arising from the transfer of a capital asset is in accordance with the section 45.5. Okay. Now, let's say, for example, in this case, let's consider and understand with this example. Let's say for the purpose of section 45(5), I have a capital asset. Now, which has been acquired by the government. Okay, this is acquired by the government. Now, I had, let's say, purchased the plot of land in 2001 for rupees 10 lakh. So, let's say, plot of land purchased in the year 2001 for the cost of rupees 10 lakh. Fine. Now, this has been compulsorily acquired at the value of 25 lakh in 2006. So, compulsorily acquired in 2006 for agreed value of 25 lakh. Fine. Now, I have received the amount in two installments. One is in 2008 and another is in 2010. So, compensation received first was in 2008, 10 lakh. The balance was in 2010, the 15 lakhs. Fine. So this is how I have received the amount. Now in this particular case, if you look at section 45(5), it says where the capital gain arises from the transfer of a capital asset by way of compulsory acquisition. By way of compulsory acquisition. Then, how do you calculate the capital gains? That is given under 45(5). Now it says the capital gain will be taxable not in the year of transfer. The capital gain will not be taxable in the year of transfer. The capital gain will be taxable. The capital gain will be taxable as the income of the previous year in which the compensation was first received. In which the compensation was first received. Are we getting that? So basically here my capital gain will not be in the previous year 2006 when the transfer takes place. This will be in the year 2008 when the compensation was first received, even though I have received only part compensation. So, chargeable to tax in the previous year 2008. Are we getting that? Now, what will be my full value of consideration? Yes, what will be my full value of consideration? Whether it will be 10 lakh or whether it will be 25 lakhs. So, my full value of consideration will be 25 lakhs. Even though I have received the part amount, my full value of consideration will be 25 lakh. Less cost of acquisition or indexed cost, let's say whatever it will be, 10 lakh. Now, this will give me my capital gain. Now, what will be my period of holding? Or for the indexed cost, till what year I will take the indexed cost? Yes, students. What will be the period of holding? Yes, Mufita, right? Yes, what will be the period of holding or indexed cost? Yes, Mansha, very good question. Then under 45(5), whether the compulsory acquisition by the state government is considered. So the Act says that if there is a compulsory acquisition under any law, It says capital gain arising from the transfer of a capital asset by way of compulsory acquisition under any law, that will be covered here in 45(5). Okay. So even when the state government has acquired, it will be covered under 45(5). Fine. Yes. 2001 to 2006, Mufita. That's correct. So the period of holding will not be till 2008. It will be from 2001 to 2006. Yes. Okay, students. So indexation and period of holding will be till this particular point of time. Now, let's say, for example, let's say I am also receiving some enhanced compensation, because let's say, for example, I had filed a dispute. I was not happy with the compensation and I won the dispute and I won the case basically, and I received the enhanced compensation. Let's say in 2012, I was given the enhanced compensation. So let's say enhanced compensation in 2012, 3 lakh, let's say legal fees is rupees 30,000. So in this particular case, the section 45(5) says, that even when the enhanced compensation is received, that will also be deemed to be the income chargeable under the head capital gains in the previous year in which the enhanced compensation is received. So when I receive the enhanced compensation, I will be taxed in that particular year. Are we getting that? So just write down over here. Enhanced compensation chargeable to tax in previous year 12-13. That is year in which enhanced compensation is received. And this is in year in which first compensation was received. Okay. Enhanced compensation will be chargeable to tax in the previous year in which the enhanced compensation is received. So how will my computation take place? My FVC will be equal to 3 lakh minus expenses on transfer 30K. So 2.7 lakh, there is no cost of acquisition, that will be nil. So 2.7 lakh will be my capital gain. Now, whether it will be short-term or long-term capital gain, what will be my period of holding? Yes, what will be my period of holding in this particular case? So my period of holding will be that of the original asset. My period of holding will be that of the original asset only. Are we getting that? So my period of holding will be that of the original asset itself. Are we clear? So cost of acquisition will be nil, but my period of holding will be of that of the original asset itself. So just write down. Write down of original asset, which is 2001 to 2006. Yes, students, is it clear? Fine. Now, let's say, for example, the compensation has been reduced. Let's say in the dispute, the compensation gets reduced. Let's say in the dispute, the compensation gets reduced. Are we clear? So in that particular case, what will happen? If the compensation gets reduced and the capital gain has already been charged, and subsequently the compensation gets reduced by the court, then the capital gain will be recomputed by way of a rectification order passed by the AO under section 155. So, capital gain shall be reduced by way of rectification under section 155. Fine. Now, let's say for example, I receive the interest on the enhanced compensation. When I'm receiving the enhanced compensation, let's say I'm also receiving the interest on the enhanced compensation. Now, what will be the situation? What will be the taxability of that? So, interest on enhanced compensation will be chargeable to tax under section 56 of the Income Tax Act. So, interest on the enhanced compensation is specifically chargeable to tax under section 56. Under section 56, it is specifically chargeable to tax. Are we getting that? So that is under the head income from other sources. So interest on enhanced compensation, which is there, that will not be chargeable to tax under the capital gain, but that will be taxable under the specific section under 56. Are we clear? So just write down. Interest on enhanced compensation. Interest on enhanced compensation will be chargeable to tax under income from other sources. Will be chargeable to tax under income from other sources. Section 56 to 8. Income from other sources. Fine. Now this shall be chargeable in which year? So the interest on enhanced compensation will be chargeable in the year, will be deemed to be the income of the year in which it is received. So this will be, let's say for example, we can write it over here, interest on enhanced compensation. Let's say in 2013, it is received for 50,000. So this is chargeable to tax in the previous year in which it is received. This is as per section 145B of the Income Tax Act. This is in the year 2013. Yes, students, is it clear? So interest on enhanced compensation will be taxable in the year in which it is received. Now understand one particular thing. There will be also the TDS on such compensation which is paid. So where any compensation or enhanced compensation is paid on account of compulsory acquisition in respect of any immovable property, then the TDS will be 10%. However, there will not be any TDS if it is less than rupees 2,50,000. So you can write down TDS on compensation or enhanced compensation on compulsory acquisition of immovable property, 10% under section 194 LA. No TDS if compensation less than rupees 2.5. Compensation less than rupees 2.5. Fine. Now, again, if you remember, in the case of conversion of capital assets into stock in trade, I told you at that point of time that, let's say, for example, if I want to claim exemption under 54 EC. So for purpose of 54 EC, I need to deposit the amounts within 6 months from the date of transfer. Now here, in the case of conversion of capital asset into stock in trade also, the transfer is happening when the transfer was happening when the capital asset was converted into stock in trade. Isn't it? So if you look at the definition of the transfer, for a capital asset which is converted into stock in trade, that is specifically considered as transfer, isn't it? So conversion of capital asset into stock in trade, this is specifically transfer under section 247. So what did I tell you? That for the purpose of 54 EC, for the purpose of 54 EC, we will calculate the 6 months from the sale of the stock in trade and not from the date of conversion of capital asset into stock in trade. Similarly, here also we will consider the 6 months from the year in which the compensation is received and not from the year in which the land is compulsorily acquired. So just write down over here. Section 54 EC to apply. Sorry, you can write like this. 6 months for the purpose of section 54 EC to be reckoned from from the date of receipt of compensation and not from date of compulsory acquisition. Fine? Is this clear? Yes or no, students? Okay. Now there are certain compulsory acquisition which are exempt by the law itself. So compulsory acquisition of agricultural land, it is exempt under section 1037 itself. Are we clear? Second one is compulsory acquisition under right to fair compensation and transparency in Rehabilitation and Resettlement Act. So there is a right to fair compensation and transparency in Land Acquisition, Rehabilitation and Resettlement Act. That is also exempt under that particular section itself, under that particular act itself. So again, that will not be considered as chargeable to tax. Are we clear? Now, one important ruling. First, we'll write down which are the exempt ones. Just write down. Compulsory acquisition of agricultural land exempt under section 1037. Compulsory acquisition of land under Right to Fair Compensation Act exempt. Fine. Now, understand one thing. There is a Supreme Court ruling on the point of compulsory acquisition of agricultural land. Now, this ruling, what does it say? So, in this case, there were proceedings which were initiated under the Land Acquisition Act for compulsorily acquiring the land. Now, there, the SSC had the opportunity to negotiate the compensation for the land. And after the negotiation, the amount was fixed. So the revenue argued that because the SSC had the opportunity to negotiate the compensation, it does not remain a compulsory acquisition. Because what is compulsory acquisition is that I will have the right to decide the compensation. And if you are in fact getting a right to participate in the negotiation, then that does not be a compulsory acquisition. So, based on the negotiation, the revenue argued that this should not be considered as compulsory acquisition of land. Agriculture, it was an agriculture land, and therefore this should not be exempt under 1037. This is in fact a voluntary sale. And voluntary sale of agricultural land will not be exempt under 1037. Of course, sale of agricultural land, then you need to identify whether it's a rural or the urban, right? And then based on that, you can say that whether there will be exemption under the capital gain or not. If it's a rural agricultural land, it will not be a capital asset itself. But if it's an urban agricultural land, then there is no exemption. But in case there is a compulsory acquisition of rural or urban land, if it is agricultural in nature, that will be exempt straight away under 1037. Whether it is rural or urban agricultural land. So here, since the SSC had the opportunity to negotiate the pricing, the revenue contended that this is not the agricultural, this is not the compulsory acquisition. Supreme Court said that just because the compensation is based on the agreement between the two parties and is subject to the negotiation, that will not change the character of the acquisition from compulsory to voluntary. Supreme Court said that the proceedings for acquiring the land were initiated under the Land Acquisition Act. And therefore, it makes it a compulsory acquisition only. And therefore, we will charge the, we will exempt this particular capital gain under 1037. Are we clear? So this was considered to be exempt under section 1037. So just write down Supreme Court in Balakrishnan case. Negotiation of compensation. Negotiation of compensation does not change the character of acquisition from compulsory to voluntary. Since land was acquired under Land Acquisition Act It was compulsory acquisition of agricultural land. The same would be exempt under section 1037, even if compensation was agreed by two parties. Okay. Yes. Yes, students, are we clear? Yes, Mansha, agriculture land, urban and rural both are exempt under 1037. So this will include urban plus rural. Yes or no? Are we clear? Fine. Okay. Now next is section 45 5A. Next one is section 45 5A. So just write down 45 5A. This is joint development agreement. 45 5A is the joint development agreement. Now understand this thing very, very carefully. Okay. Now let's say, for example, there is owner of land. Let's say there is owner of land. Now he could be either individual or the HUF. Let's say there is owner of the land, could be individual or Hindu undivided family HUF. Now he is having this land. Okay. Now what he will do is he will enter into a specified agreement. He would enter into a specified agreement for development of land with the land developer. So what does happen is that, let's say there are these farmers, there are these people who are living in village. They generally own huge plots of land. And these builders who are there, the developers who are there, real estate developers, they reach out to these farmers or to these villagers that we'll take your land and we are going to construct a huge project or a building on this piece of land. And in return, what we will do is we will give you a flat in this building that we are going to construct. So you give us the land, we will give you in return, a flat in this particular building, or let's say a bungalow in this particular property, in this entire project that we are building on. So that is a very, very common practice. Now, let's say, for example, there is this landowner who could be individual or HUF. He has entered into a specified agreement with the builder or developer for the transfer of land or building. Are we getting that? And he is going to receive in consideration, a developed property or share in the developed property plus some monetary consideration. So he will receive as a compensation share in the developed property plus some monetary consideration. Are we getting that? Now, if you look at the definition of transfer, let's say this agreement was signed for the transfer of land and building, let's say in 2008. And the share in developed properties, let's say given in 2015. Now, if you look at the definition of transfer under section 247 of the Act, if you remember, there was a specific clause. What did that say? It said that the transfer includes the transaction involving allowing of the possession of any immovable property to be taken or retained in the part performance of the contract. So, the transaction involving the allowing of the possession of immovable property is considered as transfer under section 247. So, ideally, the capital gain should occur when? In 2008. So, the capital gain in 2008 as there is transaction involving transfer of possession of immovable property, right? In the year 2008 under section 247, right? Now, understand the difficulty for the owner of the land. He has not even received any consideration. He has not even received the share in the developed property. He has just given the possession of his land. And he is being charged to capital gains, isn't it? So, in order to give relief to such kind of transactions, there is a specific charging section under section 45(5)(a). Now, what does section 45(5)(a) says? That the transfer will not be taxable in the previous year in which the land is transferred. It shall be chargeable to tax in the previous year in which certificate of completion is received to the project. In the year in which certificate of completion is received to the project. So you can just cut it like this and write section 45(5)(a) specifically provides that it shall be taxable in the previous year in which completion certificate is received. In the previous year in which completion certificate is received. Are we getting that? So it shall not be taxable in the previous year of transfer. This is in year of transfer. It shall be taxable in the year in which completion certificate is received. Are we getting that point? So that is why this is a specific charge. This is a specific charge. Clear? Now understand one thing here, very, very important. What is the meaning of the specified agreement? What do we here mean by the specified agreement? Now the specified agreement here means that when I'm transferring, when a registered agreement is entered in, where a person owning the land or building allows the another person to develop a real estate project on such land or building. So in effect, here there is no transfer of land per se, there is just transfer of the possession of the land. So here you can write it like this. Here you can write allowing the possession of land and building. Allowing the possession of land or building. Okay, so you can write down specified agreement means a registered agreement in which the owner of land or building gives the or allows the real estate developer so this is the real estate developer to whom the land is given, right? To whom the land is particularly given or building is given, allows the real estate developer to develop a real estate project on such land or building. To develop real estate project on land or building. In consideration of what? Share in the land or building or in such project. In consideration of share in such project. So he's not transferring the ownership of the land, he's just giving the possession of the land. Are we clear? Yes or no? Fine. Okay. Now, what will be my full value of consideration? So just write down. Now, the taxability will be in the previous year in which the completion certificate is being received. Now, what will be my full value of consideration? Just write down. Full value of consideration is equal to stamp duty value. My full value of consideration will be equal to the stamp duty value on the date of issue of completion certificate. On the date of issue of the completion certificate plus the consideration if received in cash. Plus the cash or the monetary consideration. So SDV on the date of issue of certificate, which is pertaining to my share in the land or building or my share in the project plus the cash consideration. SDV of share in project on the date of issue of CG. On the date of issue of CC. So SDV of what? My share in the project, which is the share in the project is basically land or building. Okay. And what will be my cost of acquisition? Cost of acquisition will be the actual cost. Right? Cost of acquisition will be the actual cost. Again, period of holding will be my actual period for which I have held the asset. Are we clear? So period of holding again will be till year. From purchase till transfer of possession. And that's why I will have even the indexed cost of acquisition. Okay. Now, on this particular point, there is an exception. Now, what is the exception over here? The exception is if the share in the land or building is transferred. If the share in the land and building or is transferred before the issue of completion certificate. So let's say, for example, if before I receive the completion certificate, I'm transferring my share in the developed project, then 45(5)(a) will not apply. So you can write down exception if share in the project is transferred before the CC is received. If the share in the project is transferred before the CC is received, then capital gain deemed to be income of previous year in which transfer takes place. So capital gain deemed to be the income in which the transfer takes place, which will be in this case, let's say 2008. So if share sold before 2015, then it will be taxable in the year 2008. That is, normal provision will apply. And in that case, my full value of consideration will be the stamp duty value of the share as per section 50C. Right? As per section 50C, and it will not be as on the date of receipt of completion certificate. Rest, everything will remain the same. Clear? Let's say, for example, if the share in the land or building is transferred after the issue of completion certificate, then let's say, for example, if share in project transferred after the issue of completion certificate, later on if I am selling that, then my full value of consideration will be the stamp duty value as per section 50C, right? Less what will be my cost of acquisition of that share? What will be the cost of acquisition of that share? That will be this. The stamp duty value as on date of issue of CC. So what is tax to me under 45(5)(a) if I sell that particular share later on, then in that case, that will be considered as my cost of acquisition. Are we clear? Also, there is one TDS provision which is applicable on this, on the monetary consideration that is received. There will be TDS under section 194 IC. There will be TDS under section 194 IC. And what will be my TDS? My TDS will be 10%. My TDS will be 10%. So just write down. On monetary consideration, there will be TDS under 194 IC. Yes, students, clear? Yes or no? Okay. So let's take a small break of 10 minutes and let me get back. Let's take a break. So this was the entire charging section under section 45. So 45.1 general charge, 45.1a was the insurance compensation exception to the general charge. It is taxable in the year in which insurance compensation is received. But the period of holding will stop till the year in which the asset gets destroyed. 45.2 which was there was in connection with the 45.2 was in connection with what? Yes, faster. The conversion of the stock capital asset into stock in trade. So again, the period of holding will stop when the capital asset is converted into stock in trade, but it will be chargeable to tax in the previous year in which stock in trade is sold. And there will be capital gain as well as PGBP in that particular year. For 54 EC, you will get the 6 months reckoned from the date of sale of stock in trade and not from the year in which the capital asset is converted. So capital asset converted into stock in trade is specifically covered in the definition of transfer. Then 45.2a was with respect to the ULIPs. If you pay consideration more than rupees 2.5 lakh, the premium amount, then the consideration that is received for the ULIPs, that will be chargeable under 45.2a, because ULIP, when your premium exceeds the rupees 2.5 lakh, it is considered as a capital asset. It is considered as a capital asset under section 214. And otherwise, if it is less than 2.5 lakh, then it is exempt under section 1010D. Right? It is exempt under section 1010D. So that is again for the ULIP. Then with respect to the 45.2, which is for the conversion of capital asset into stock in trade. Sorry, 45.2a was what was in respect of the FIFO basis, and the capital gain will be chargeable in the hands of the beneficial owner and not in the hands of the depository, right? So, and then 45.1b is your ULIP. So 45.1b, you can just write it over here. ULIP where premium exceeds rupees 2.5 lakh, capital asset under section 240. So just specifically write over here. Okay. Then we had 45.3, which was on the admission of partner. The full value of consideration will be the amount recorded in the books of the firm, and it will be transferred taxable in the year in which it is transferred. 45.4 is in respect of the capital asset or money received on the reconstitution of the firm, and then A is equal to B plus C minus D under 45.4. Also, you will have 9B. Then 45.5 was in respect of the enhanced compensation or the compensation received on the compulsory acquisition of land. So when you compulsorily acquire the land, the capital gain will be there in the year in which the compensation is first received or in the year in which enhanced compensation is received. But the period of holding is still year when the actual compulsory land is acquired. Okay. Then we had the 45.5a, which was joint development agreement. In that case, if there is a specified agreement, then the capital gain will be chargeable in the previous year in which the completion certificate is received. And your FPC is equal to stamp duty value on the date of receipt of the completion certificate. Yes, so this is your entire section 45. Fine. This is your entire section 45. Are we clear? Yes or no? Any questions so far? Any doubts or any questions so far? Yes, students. Yes, clear. Yes or no? At least answer me. Yes, students. Yes. All of you, fast. Okay. Yes. So let's proceed then. The next section which we are going to discuss now is section 46. Section 46. Okay. Viraj is 45.2 of general insurance receipt and 45.3 of ULIP. Viraj, 45.1A is of the general insurance and 45.1B is of ULIP, not life insurance but the ULIP. Okay. Yes. Okay. So let's proceed further then. Then next we are moving on to section 46 because we are done with section 45 in detail. Now let's move on to section 46 of the Act. Now section 46 is in respect of the liquidation of the company. Just write down section 46, liquidation of company. Now, if you look at the liquidation of the company, okay, now the liquidation of company which takes place, right? There will be taxability in two aspects. One in the hands of company, secondly in the hands of shareholder. One is in the respect of the hands of the company. Secondly, it will be in the hands of the shareholders. Now, how does the taxability function? Let's try and understand very, very carefully. Now, in the hands of the company, when the assets are distributed on the liquidation. So, on the liquidation, the assets are distributed, right, to the shareholder. That distribution will not be regarded as transfer under section 46. So, in the hands of the company, not a transfer. In the hands of the company, it is not considered as the transfer. Are we clear? So, this is section 46(1). So, distribution of the assets will not be considered as a transfer for the company. Are we clear? But let's say, for example, if the liquidator of the company sells the asset and then pays the cash to the company shareholders. So see, the liquidator has an option. Either he can just give the asset to the shareholders. That is not considered as transfer under 46(1). Or he can sell the assets in the market and whatever proceeds he realizes, he can pay those proceeds to the shareholder. So if the liquidator sells the assets in the market, then he will have to pay the capital gain. Then he will have to pay the capital gain on the sale of the assets. And when they distribute the funds to the shareholders, if the liquidator sells the asset and distributes the funds to the shareholder, then the company will be liable to pay the capital gain tax on the sale of the assets. But when the company is giving the assets to the shareholder on liquidation, it is not selling the asset in the market, then there will not be any capital. Are we clear? In the hands of the shareholder, this will be chargeable to tax under the head capital gain. So this will be taxable in the hands of the shareholder. So the amount which is received on the liquidation will be considered as taxable in the hands of the shareholder. But also remember one thing very, very, very clearly. Now, in the hands of the shareholder, as I said, what is taxable? So the shareholder is extinguishing his shares when the company is getting liquidated and he's getting the capital asset. Now that is taxable in the hands of the shareholder. So just write it over here. The shareholder, this is the company in liquidation. So he's transferring the shares, extinguishment, and he's getting the capital asset or cash in return. So this is taxable under section 46(2). Here write down distribution of capital asset to shareholders. Distribution of capital asset to shareholders, not a transfer under section 46(1). But in the hands of the shareholder, this receipt which is there, because the shares are getting extinguished, this will be taxable under section 46(2). Okay, so capital gain in the hands of the shareholder. Now, what will be my full value of consideration? My full value of consideration will be capital gain taxable under 46(2), FMV of the capital asset received, not asset, but the capital asset received. So my full value of consideration will be the FMV of the capital asset received as on the date of distribution. As on the date of distribution minus deemed dividend under section 222C. Are we getting that? So in the hands of the shareholder, there will be two implications that we are going to talk about. Right? There are two implications in the hands of the shareholder. One is the capital gain which is taxable under section 46(2). The capital gain which is taxable under section 46(2). That is my first implication which is there. The second one is deemed dividend under section 222C. Now, what does section 222C provides? So, section 222 defines the term dividend. It says dividend includes any distribution made to the shareholders of a company on its liquidation to the extent of the accumulated profits. So, deemed dividend under section 222C is to the extent of accumulated profits. Now, if the amount is already taxed under section 222C, I will reduce it from the full value of consideration under section 222C. Are we getting that? So, I will reduce it while calculating the capital gain. Are we getting that? Now, what will be my period of holding over here? Cost of acquisition will be what? Cost of the shares. Cost of acquisition will be the cost of the shares. So you can write down minus cost of acquisition is equal to the cost of shares in company. What will be my period of holding? This is very, very important. Now, what will be my period of holding? Yes. So, my period of holding over here will be period or year, previous year in which shares are purchased, till date of commencement of liquidation. Till date of commencement of the liquidation. So my period of holding over here will be date from which the shares are purchased till the date of commencement of the liquidation. Are we clear? and the capital gain which will be there shall be taxable under section 111A if it is short term, 112A if it is a listed, and 112 if it is unlisted. And since here most likely it will be a case where the security transaction tax is not paid, so 112 will be applicable. Okay, because these are the shares which are transferred. Shares are transferred, so here the capital gain will be taxable under 112, or you can just remove it, because most of the time on liquidation, the liquidation, the STT is not paid. So the taxability will be under 112 only and not 112A. 112A applies when on the sale and purchase you pay the STT. Fine? Yes or no? Yes. Is this clear? So on liquidation, what happens is we will have the deemed dividend also in the hands of the shareholder. Also, we will have the capital gain in the hands of shareholder. In the hands of company, it will be exempt. Okay? Yes or no, students? Are we clear? Fine. Now, let's say, for example, where the asset which is purchased is now sold. The asset which is received in liquidation when it is being sold. So, where the shareholder is receiving an asset on liquidation. Right? Now, what will be the cost of that asset? So, the cost will be the FMV on the date of distribution. So, you can write here where capital asset received on liquidation is sold. So FVC will be your actual sale consideration minus cost of acquisition will be this. FMV on date of distribution. Okay, FMV on the date of distribution. Fine. What will be my period of holding? What will be my period of holding? So where the capital asset is received on liquidation of the company. Right? So then in that particular case, what will be my period of holding? Yes, students. What will be my period of holding? Yes. So my period of holding in this case will be the period for which I have held the asset. Because here this asset which is received by me, I've already paid the tax on it. Isn't it? So therefore, it will not include the previous owner's period. Here, it will not include the previous owner's period. This is not the property which becomes my property by virtue of section 49(1). If only where the property becomes the property of the assessee by virtue of section 49(1). 49(1) we'll see it in great detail, but that is a case where if under 49(1) you are covered, then it is always the case where the period of holding gets clubbed. The period of holding gets clubbed. So 49 is basically in respect of the period of holding. It's in respect of the cost to the previous owner. And for clubbing the period of holding, that whatever period of holding for which the previous owner was holding the asset for, that period will now be clubbed with this particular owner. Are we getting that? So the previous owner's period is clubbed where the property is passed on to you in terms of section 49(1). In terms of section 49(1). Now, in that particular case, whether liquidation, whether the property which is distributed to the assessee, the capital assets which are distributed to the assessee on the liquidation, what will be the period of holding for that? So, in that particular case, the period of holding here will be for the asset when it is sold, the period of holding will be period of holding from when asset was held by the liquidating company. Asset was held by the liquidating company. Okay. So you will club the period of holding. Clubbing of period of holding under section 242A. Clubbing of the period of holding under section 242A. Yes or no, students? Are we clear? So is liquidation clear? Shall we solve one question on that? Okay. Let's solve a question. Yes, I'm just giving you the question. So just write down. Write down. Let's say ABC Limited went into liquidation on 1/6/2023. On that date, the company possessed the following funds. Share capital 5 lakh. Reserves 3 lakh. Excess realization. Excess realization in course of liquidation 5 lakh. This is 13 lakh. There are 5 shareholders who received rupees 2.6 lakh in settlement. Yes. How will you calculate? Yes, calculate. Mufita, clubbing of period of holding means that, let's say, for example, the company had purchased the asset in the year 2013 and now it is being given to me in 2000 and let's say 20. So for me, the period of holding will be from 2013 and not from 20. Okay, Mufita? That is the clubbing of period of holding means the period of holding of the earlier previous owner is also clubbed. Yes, students, faster. Okay, so first year there will be deemed dividend. Yes, students, first year there will be deemed dividend. Right? Are you with me? Nobody is giving me the answer. So first there will be deemed dividend. How much will be deemed dividend? So there are 5 shareholders, right? So my reserves are divided amongst then the 5 shareholders, right? It is 5 lakh. So 3 lakh accumulated profits is 3 lakh. The share of each shareholder in the accumulated profit will be 60,000. Share of each shareholder will be 3 lakh divided by 5, 60,000, right? So the deemed dividend will be this particular amount. So my deemed dividend will be 60,000. Okay. Balance 2 lakh which is there. Capital gain under section 46(2). For the company, it is for company. This is not transfer under section 46(1). Right? For 46(2) which is there, for 46(2) it is there. This will be my full value of consideration, which will be 2.6 lakh minus 60,000, 2 lakh minus the cost of acquisition. Here indexation is not given. Okay, here the benefit of indexation may be available because the shares are held for more than 24 months. These are unlisted shares. But here, since the indexation is not given to me any information, so I'm not taking the indexation. Okay, so what will be my cost of acquisition over here? The cost will be basically my cost which I have invested. So the share capital is 5 lakh. That is again will be divided between the different shareholders. So it will be 1 lakh each, right? So just write down share capital is 1 lakh. So 1 lakh will be my capital gain. 1 lakh will be my capital gain. Right? So here it will be taxable at the rate of 20%. Tax at the rate of 20%. Now here, whether 54 EC will be available, section 54 EC, answer is no. 54 EC will not come into picture because 54 EC is on the transfer of land and building and not on the transfer of shares. Clear? Okay. One more example. Let's just write down. Let's say for example, ABC Limited has gone into liquidation. The balance sheet before liquidation was as follows, right? Asset or capital asset, you can write 10 lakh, share capital 5 lakh, accumulated profits, which could be, let's say, my general reserves 3 lakh, let's say revaluation reserve 2 lakh. Okay. So this is my 10 lakh. This is acquired in 2013. This is also since 2013. Okay. Now, there are let's say 5 shareholders. The capital asset is distributed proportionately. Okay. Then you can write down the capital asset acquired was sold by Mr. A, shareholder, for rupees 3 lakh on 1/11/2023. Okay, on 1/11/2020. The company has gone into liquidation on, let's say, 1 June 2020. So what will be my deemed dividend? What will be my deemed dividend? Let me just, tell me what is the deemed dividend. Yes, Mofita, correct. So my deemed dividend will be share in accumulated profits, which is again 3 lakh divided by 5, so 60,000. So 60,000 deemed dividend for each of the shareholder. Then 46(1), not taxable in the hands of company. So distribution of assets not taxable in the hands of company. For 46(2), taxable in the hands of shareholder. This will be taxable in the hands of the shareholder. So what will be my tax implication? My full value of consideration will be how much? So 10 lakh asset is distributed among 5 shareholders. So 2 lakh minus 60,000. This will be 2 lakh minus 60,000. 1,40,000 minus cost of acquisition. Again, this will be 1 lakh Here again, indexation is not given, so I'm not considering. So 40,000 is my long-term capital gain, tax at 20%. Okay. Now, when capital asset is sold by Mr. A, when the capital asset is sold by Mr. A, my full value of consideration will be 3 lakh minus my cost of acquisition as per section 55 will be what? This will be 2 lakh. Are we clear? So this will be 1. Now whether this will be long term or short term? Yes. Whether this will be long term or short term? Yes, students. Mofita, FPC will be 1 lakh 40, not 2 lakh 40, right? Yes, whether capital gain will be long term or short term. Students, please answer. Nobody is answering. If you will not answer, you will make mistake in exam. Mohammed, no. It will be a long term and not short term. Just put a red mark in your notebook so that you don't make this mistake in exam. What did I just say? That the period of holding will be clubbed. The period of holding will be clubbed in this particular case. So, my period of holding will be of previous owner would be clubbed under section 242A. So, the asset has been held by the earlier company from 2013. So that period will also be considered for calculating the period of holding. Clear, Mohammed? Yes, Vanshika. Okay. Yes, are we clear about the liquidation? Yes or no? Okay, let's proceed forward. Next section, section 46A. Buyback of shares. Section 46A, which is there, which is the buyback of shares. Now understand one thing. The buyback of shares, the capital gain arises on the buyback of shares. Now you can just make a chart over here. Buyback of shares by the domestic company. By a domestic company. Second, what is a domestic company? Meantime, just start giving me the answers. By any other company. Buyback of ESOPs. Buyback of ESOPs. So what is a domestic company? Yes. Go back to the basic concept lecture. What is a domestic company? Yes, students. What is a domestic company? Fast. Yes. Mufika, if the Mr. A has sold the asset for 3 lakh for Why will you minus 0.6 from that? The deemed dividend has to be reduced from the consideration, full value of consideration that you are charging under 46(2). When the capital asset which he has received from the distributing company, when that will be sold, at that time you will not reduce the deemed dividend, Mufita. Are you getting that, Mufita? So, see, I have reduced here 60,000 when I am calculating 46(2), because the deemed dividend has already been taxed under E4s. Now, when I am considering the capital gain on the distribution of the asset, at that time I will reduce the 60,000 when the asset is sold later on by Mr. A. This capital asset which he has received, now he's selling that asset. At that time, I will not reduce 60,000 because I've already reduced 60,000. Are you getting that? So here, 60,000 was taxed under E4s. 2 lakh, 1.4 lakh is taxed under 46(2). Are we getting that? So here, what does section 55 says? Section 55 says, when the capital asset that has been received, on the liquidation, then the fair market value on the date of distribution has to be considered as the cost of acquisition. It doesn't say the full value of consideration has to be taken as cost of acquisition. Had it said that the full value of consideration has to be taken as cost of acquisition, we would have just taken the 1.4 lakh. But it says the fair market value that is considered, that will be taken as the cost of acquisition. Are we getting that? So when the 3 lakh amount which is received is for the subsequent sale of the capital asset, from that I will not reduce 60,000. And plus the cost will be the fair market value as on the date of distribution. Clear, Mufita? Yes, Vanshika. The domestic company is an Indian company plus the company which has made the arrangement for the declaration and payment of dividend in India. Vanshika, the Indian company which has made the arrangement for declaration of dividend, that is not correct. So, Indian company is always a domestic company, as well as the foreign company which has made the arrangement for the declaration of dividend in India, that is also a domestic company. So, an Indian company will any which ways be a domestic company. Are you getting that? Indian company, even if it has to make the arrangements for declaration of dividend in India. So, Indian company will always be a domestic company. It is also a foreign company which has made the arrangements for declaration of dividend in India. That company will also be considered domestic company. Yes, Mansha, very good. So, we have divided. Okay, I understood. Vanshika, it was error in sending. No problem. Okay. So, we are dividing it into 3 aspects. So first one, buyback of shares by the domestic company in the hands of the company. The buyback tax at the rate of 23.296%. Are we clear? So 20% plus surcharge plus cess. Surcharge of 12%. Then in the case of the shareholder, this is exempt under section 1034A. This you can write down 20% plus 12% surcharge plus 4%. This is under section 115 QA. Clear? Where there is buyback of shares by any other company. When there is buyback of shares of any other company, this is not taxable in the hands of company. This is taxable under section 46A in the hands of shareholder. Again, buyback of ESOPs, not taxable in the hands of company. This will be taxable under section 46A. Are we clear? So under section 46A, the amount received from the company will be considered as your full value of consideration. And the cost of acquisition, whatever cost you have incurred, that will be reduced. Fine. Here, buyback of shares, this could be listed plus unlisted. Okay, listed or unlisted. Here, students, is it clear? Okay. Yes. 115 QA Manshika. Fine. Now we are done with 45, 46, 46A. Next is section 47. Now 47 means the transactions not regarded as transfer. There are certain transactions which are not regarded as the transfer. Now we are not going to do at the time that particular provision. We are not going to do at the time that particular provision, that we are not going to look at all the transactions under 47 that are not regarded as transfer. So we are going to do in bits and pieces depending on the nature of the transaction. But understand one thing. When a transaction is not regarded as transfer under 47, a transaction not regarded as transfer under section 47. In that particular case, there are many transactions like that which are not regarded as transfer. Even if it is a transfer, but it is exempt specifically under 47. So it says notwithstanding anything contained in 45, these transfers, these transactions will still be exempt. These will not be regarded as transfer. For example, the transfer of a capital asset under a gift or will or under an irrevocable trust, distribution of capital assets on the partition of HUF, amalgamation, demergers, business reorganizations, and there are many other transfer which are not regarded, there are many other transactions which are not regarded as the transfer. Are we getting that? Now, whenever a transaction is not regarded as the transfer, in that particular case, understand one very, very important thing. When I receive an asset and the transaction is exempt under 47, then my cost of acquisition of the asset will be the cost to the previous owner. This is under section 49(1), which I was talking about even by liquidation. So if you look at the liquidation, they say that the distribution of assets under liquidation, for that the cost will be the cost to the previous owner, but in respect of the liquidation which is chargeable under section 46, in that particular case, in that specific case, when the asset which is sold, which is received under distribution, since there is a taxability in the hands of shareholder under section 46, section 55, which defines the cost of acquisition, says that the cost of acquisition in the case of liquidation will be the fair market value on the date of distribution. This is this concept where we provide the cost as the fair market value. Since it has been already taxed, I am taking that as the fair market, as the cost. That concept is known as the step-up cost. Step-up means I am inflating the cost because I'm trying to give you the relief of the amount which I have taxed you earlier. If I take the cost, which is cost to the previous owner, you have already been taxed on the fair market value. And now you're not even getting the deduction of that fair market value when you're selling the asset. So this concept is known as the step-up cost. That is under 55. But under 49, whenever a transaction is exempt under 47, the cost will be the cost to the previous owner because I have not paid any cost as such. I have acquired these kind of assets by way of some different means rather than the sale of the asset. So the cost of acquisition will be the cost to the previous owner. Similarly, the period of holding will include the period of holding of the previous owner. Section 242A, explanation 1. So explanation 1 to section 242A provides for the clubbing of period of holding. So see, for the liquidation also, what did I say? We will club the period of holding of the assets which are sold, which were received on the liquidation. Because there is a reference of the liquidation, the assets received on liquidation under section 49(1). And whenever the cost is of the previous owner, the period of holding of the previous owner also gets clubbed. Are we getting that? So explanation 1 provides that the previous owner's period will be clubbed with the current owner's period. Now, as far as the indexation is concerned, so indexation also available from the year in which asset was first held by the previous owner. So the asset was first held by the previous owner. From that date, we will consider from that period the indexation will be available. Now this is not written under the Act. This has been interpreted by the Bombay High Court in Manjula Shah ruling. So this you will have to remember. Yes, students, is it clear? Yes. Yes, Mansha. CIT versus Manjula Shah. Okay. Viraj, the board of directors of TCS have approved a proposal to buy back the shares. Yes. So in that case, they will have to discharge by the buyback tax. They will have to collect the buyback tax. Yes, students. So first now, let's get started with the specific transactions that we are going to talk about. Okay. So the first transaction that I'm going to talk about is in respect of the conversion of debentures to the equity shares. First is conversion of debentures to equity shares. Now, under section 47, which is there, the conversion of debentures to equity shares, though it is an exchange, it is falling within the definition of transfer under 247. But specifically, section 47 provides that that the conversion of the conversion of the debentures to the equity share will not be considered as a transfer. So, conversion of the equity share or the bonds, or conversion of the bonds or debentures into the shares will not be considered as the transfer. Are we clear? So just write down, not regarded as transfer under section 47. Now, what will be the cost of acquisition of the equity shares? What will be the cost of acquisition of the equity shares? Now see, I have purchased the debentures. I have purchased the debentures. Now in that particular case, I have not purchased the equity shares. By virtue of the debentures, I am getting the equity shares now. Isn't it? So for that purpose, what will be my cost of acquisition? So my cost of acquisition will be the cost of the debentures. So when the equity share will be sold, what will be its cost? The cost will be the cost of the debentures. So just write down. Cost of equity share will be the cost of debentures. This is under section 49. This is given under section 49. Now, what will be my period of holding for the equity shares? What will be the period of holding for the equity shares? Now, this is not given under 242A. So, the CBDT has inserted the rule to provide for the determination of the period of holding of the capital asset. Which rule? Rule 8AA. Rule 8AA, something strikes you? What was Rule 8AA for? Yes, Rule 8AA is a similar rule that we have already done. Which rule? What does Rule 8AA also provides for? Yes, Rule 8AA talks about something else also. Yes, Rule 8AA, Rule 8AA. It talks about something else as well. Yes, let me see who answers. Yes, Rule 8AA just now we discussed some time back at the start of the class. Yes, I'm giving you so many hints. What does it talk about? Let me see who answers. Yes, students. Rule 8AA talks about something. Yes. No, Geeta, it doesn't talk about LTCG. Let me see who gives me the answer, correct answer. No, Vanshika, not the step-up cost. That was rule. That was not even coming through the rules. That was through the CBDT circular. Rule 8AA. We discussed as the first thing today in the class. Geeta, period of holding for what? For which transaction? Mansha, period of holding for which transaction? Yes. Nobody is giving me the right answer. Yes, Mopita, correct. 45.4. So when you are required to determine the period of holding, or when you are required to determine the nature of the capital gain for 45.4, Rule 8AA told you that the capital gain will be determined based on the period for which the asset to which the 45(4) is attributable. According to that, your capital gain will be determined under 45(4). So, Rule 888 also talks about 45(4) nature of capital gain. It also talks about the debentures converted to equity shares. It says the period of holding for the equity shares will include period of holding of debentures. Okay. Yes, Viraj. Clear. Very good. So it talks about the type of capital gain for the 45(4). Clear? So in terms of the debenture which is converted to equity share, it will include the period for which the debenture was held. Clear? Okay. Now, next particular is conversion of preference shares to equity shares. Now again, preference shares to equity shares, when they are converted, it is an exchange. So therefore, it is regarded as a transfer under 247. But specifically, it has been exempted under section 47. So section 47 specifically exempts it and says that this will not be regarded as the transfer. So just write down. It's the same as debenture only. Not regarded as transfer under section 47. Cost of acquisition of equity shares will be cost of preference shares. This is under section 49. Similarly, period of holding for equity shares will include the period of holding of preference shares. Now, this is not coming through rule. This is coming through explanation 1 to section 242A. Okay. Fine. Yes. Next is redemption of preference shares. Now, whether redemption of the preference share is considered as taxable or it is not regarded as transfer. So, in case of the redemption of the preference shares, this is considered as the taxable transfer. Redemption of the preference shares is considered as the taxable transfer. Similarly, the redemption of the share capital or reduction of the share capital, that is also considered as transfer since there is extinguishment of the rights. Since there is extinguishment of the right. So just write down redemption of preference shares or debentures transfer under section 247. Reduction of share capital, again this is regarded as transfer under section 247. So when the share capital gets reduced, that time also it is regarded as transfer. Are we clear? Because you are cancelling out the shares. Next particular transaction which is there. This is in respect of the rupee denominated bonds. Rupee denominated bonds. So just write down. So these are different instruments that I am covering with you. rupee denominated bonds. Now, these are the bonds which are denominated in rupees. Are we getting that? So, what are these basically? These are issued to the non-resident or outside India, but these are denominated in the Indian currency. These are denominated in the Indian currency. So basically the Indian companies, in order to raise the funds from outside India, they have been permitted to raise the money not only in foreign exchange, but they can also raise the money in the rupee. So in case of the non-resident, these are only subscribed by the non-resident and these are issued by the Indian company. These are also called as masala bonds. So in case of the non-resident, any appreciation of rupee which is happening between the date of purchase of bond and the date of redemption of the bond, right? So they have invested in the INR, but there will be appreciation in terms of the amount that they would have originally purchased for the investment through the foreign currency. That appreciation will not be included in the full value of consideration. Are we getting it? So just write down rupee denominated bonds issued by the Indian company to non-resident. So appreciation, the appreciation of rupee between date of purchase and date of redemption not to be included in full value of consideration. Are we clear? So that will not be included in the full value of consideration. Further, any transfer by one non-resident to another non-resident of rupee denominated bond this is exempt under 47. This is exempt under section 47. So transfer by one non-resident to another non-resident is exempt under section 47. Are we clear? So if one non-resident is transferring the rupee denominated bond to another non-resident, then it is not considered as the transfer. Secondly, transfer of a rupee denominated bond by a non-resident on a recognized stock exchange in IFSC, where the consideration is paid in the foreign exchange. That also will be exempt under 47. So transfer by non-resident on stock exchange in IFSC exempt under section 47 if consideration in foreign exchange. If the consideration is in the foreign exchange. Fine. Yes. Okay. Next one is consolidation of mutual funds. So, under the mutual funds, what happens is there are different plans that we purchase under the mutual fund. Now, most of the time, these mutual fund company sometimes consolidate the scheme of the mutual fund. There are different plans. What they do is they just consolidate that. So if any units which are held by the assessee and that fund gets consolidated with the other fund and that results in a transfer during the course of consolidation, right? So in that case, it will not be considered as a transfer. So what happens is the unit holder will get allotted the new units in the consolidated scheme and the earlier scheme which is getting consolidated. In that, the unit will get transferred to the new scheme. Are we getting that? So that will not be considered as a transfer. Are we clear? Just write down. Consolidation of mutual fund not regarded as transfer under 47. Okay. Yes or no? So basically what happened is that there is consolidation which takes place by the mutual fund itself. Sometimes of the scheme, sometimes of the plan. So that consolidation is not considered as the transfer. Okay. Now what will be the cost of acquisition in the new unit? So cost of acquisition of the new unit will be the cost of the earlier unit as well. So again under 49 and for the consolidation, so where the capital asset which is there is a unit which is received in during the consolidation, the cost of acquisition will be the cost of the earlier unit. Okay. So cost of acquisition of unit under new plan or scheme will be cost of unit under old plan or scheme. Section 49. And period of holding of unit in new scheme shall include period of holding of unit in old scheme. Yes, students, are we understanding this? Yes or no? Clear? Yes or no? Equity linked bonds? No, Mansha, that is not covered. Yes or no? Clear? So we can just stop here for today. In the next class, what we are going to do is we are going to cover few more instruments which are there. Like for example, we are going to talk about the ESOPs. We are going to talk about the right issues. We are going to talk about the bonus issue. All of that we are going to cover. Yes? Okay. So shall we just stop here? Yes, students. Any questions? Yes? Okay. So thank you so much. We can close the session. Let's close the session.